Happy Tuesday. It's the 14th June 2022. This is going to be a very busy week. We have 5 central banks events in 4 days starting today. In this short video, we will look at what can possibly materialize in the market from these economic events. Monitoring the main economic news events and how your favorite market or markets move around those events will bring a deeper market understanding that will assist you in your trading work. This is the reason we put billionaire trader Bruce Kovner's quote at the top of this page. Hopefully it will inspire you to dig deeper in your beautiful trading journey. The first central bank event will be the ECB on Thursday, 12:20 a.m. Singapore time or 12:20 p.m. New York time. And this will be followed immediately 90 minutes later by the US Fed with very, very important policy announcements that will probably move markets significantly. Now for the ECB, this is a public engagement for Madame Lagarde, who will be speaking at the London School of Economics. So this is not expected to be a big announcement. The ECB has already said what it needed to say last week. However, as head of the ECB, her public engagements are monitored by market participants, as they often are used to provide clues on intentions. Tradable opportunities here could result, but we believe they will be muted and potentially fake moves, as the markets will wait for the FOMC event 90 minutes later. Again, we do not trade both events, what Madame Lagarde says or what the FOMC says, what the Fed says. We will monitor markets during and after these events and look for potential setups at that time. The first central bank event will be the ECB on Thursday, 12:20 a.m. Singapore time or 12:20 p.m. New York time. And this will be followed immediately 90 minutes later by the US Fed with very, very important policy announcements that will probably move markets significantly. Now for the ECB, this is a public engagement for Madame Lagarde, who will be speaking at the London School of Economics. So this is not expected to be a big announcement. The ECB has already said what it needed to say last week. However, as head of the ECB, her public engagements are monitored by market participants, as they often are used to provide clues on intentions. Tradable opportunities here could result, but we believe they will be muted and potentially fake moves, as the markets will wait for the FOMC event 90 minutes later. Again, we do not trade both events, what Madame Lagarde says or what the FOMC says, what the Fed says. We will monitor markets during and after these events and look for potential setups at that time. Euro USD. This pair is clearly bearish, and it has been so since January 2021. If markets are allowed to do what they are supposed to do, this currency pair really wants to go below the current lows in this chart around 1.03610, and from there it wants to target the 1.02900s, and after that probably collapse altogether. However, there is a lot at stake here for policymakers. The diverging yields on European sovereign bonds we mentioned last week can create a repeat of the euro crisis we saw in 2010-2012. The ECB will be looking at easy but drastic fixes that will convince the world that euro bonds are safe across the board. Would that mean a change of trend in the euro? Unlikely, but central banks can pull out surprises out of their hats in desperation. A change in trend in the euro would also mean a drop in the dollar index. After all, they move, they seem mirror images of each other. Is that possible? It's unlikely now, as the Fed in the US needs to raise rates to face the high inflation they have at the moment. Understandably, the Fed is reluctant to do so due to the mind-boggling interest payments they would have to pay as a result of rate hikes. And recently we heard policymakers talking about, in the US, attacking demand. Now, what does that mean, attacking demand? Well, that's a surprise out of the desperation hat. The Fed will be looking for any opportunity to quickly pare down rates at the first whiff of economic troubles. Now, this could take the form of an aggressive drop in equity markets, or a bad print in employment data, or economic data showing lower incomes for workers and family across the board. In summary, if a lowering of living standards across the US were to happen, that would instantly fix the inflation problem. Pure central bank genius. It does not matter if measures, either in Europe or in the US, are unsustainable, or the measures can create bigger issues in the future. So on the other side of the world, we have a country that can make this easier for the US and Europe. While the US and Europe are stopping QE and figuring ways to fix their inflation issues, we have Japan, which is still running QE. And as long as they are willing to buy Western debt, which offers higher yields than the Japanese bonds, the West has hope. The US can sell bonds, the Europeans can sell their bonds, Japan gets to devalue their currency in exchange, so they can get more exports to kind of make up this crazy seesaw game. But we will look at the Japanese yen in later days ahead of the central bank event this week. Focusing on the euro, we want to be short until we are proven wrong. If at some point we are wrong and markets reverse on us, we will take our losses and we will be open and ready for a potential radical change in market trend materializing as a result of what the policymakers are doing this week. A radical shift of trend of this nature will take a while to fully materialize, as the flow of the huge funds that we're talking about would take time to be diverted into different asset classes. It is important to know that this is a scenario painting exercise. We're not placing trades based on this scenario. We're discussing this on desk. We are looking at how events could radically affect or change the current downtrend in the euro. As billionaire trader Bruce Kofner said, through this game, we will be able to understand a potential trend change. Even if our scenario is not perfect and has holes all over and is highly unlikely, we would be prepared and not frozen in surprise looking at news that would explain a losing trade. We would be ready. Here's a quick updated snapshot of the diverging yields in European sovereign bonds, as well as a graph of the US government debt. Now, paying interest on that kind of debt is no joke. And some say that some governments are already broke. Anyway, moving on. Here is also, we keep monitoring government debt to GDP for the majors, so in this case US and German government debt to GDP. There's a lot to be said about this, but let's move on because we need to trade. We need to look at seasonalities just to be aware of them. Again, we're painting scenario, and we're looking at the dollar index, DXY seasonality, the tendency, not a certainty, the historical tendency is for the dollar index to drop around end June, beginning July. Now, tendencies are based on historical behaviors and could be the result of various factors: accounting year, repatriation of funds due to tax liabilities, or certain crops being in demand, or harvesting, or demand for heating oil in the case of commodities, and of course a combination of similar factors and correlations playing out against various assets seasonally. So this explains the seasonality factors, which may or may not play out, but we need to be aware of them. Conversely, the euro, which is almost a mirror image of the dollar index, has a tendency, not a certainty, to rally around end June, beginning of July. Again, these are tendencies which we put in our context scenario planning to understand potential moves that could affect our bearish buyers in the euro. We do not trade the tendency because we can easily see validation or rejection of these scenarios by looking at markets and our graphs. If the decisions taken by policymakers move markets in a way that is consistent with seasonal tendencies, how would that look in the euro-dollar graph? For the bearish trend in the euro-USD to continue, We would like to see the current low at 1.03615 taken out. And we would like to see a continuation of the move down with shallow, small retracements up. And we would like to see swing lows being broken consistently as per the crude lines we drew in the chart. So we need to see small candles moving up in a choppy fashion, contrasted by long candles moving down with power and speed. Importantly, once the prior swing low is broken, we should see the same type of strong price action printing new lows. Now, where will we look for short setups? Where will we look to sell? Well, on desk, we will look for setups to be forming around the shallow retracement at point 1. Now, your trading experience and methodology may seek different validation points or setups, and that's okay. You may like to wait for a break of the daily low before considering a short, and that is okay too. Now, your favorite setup or indicator could materialize anywhere between point 1 and the break of prior swing low. For more experienced trader using any momentum indicator of your choice, you would pick up a potential trade sometimes after point 1. Now, we encourage you to not get stuck on entries. There are many in any charts in all time frames. We are inspired by Bruce Kovner, and we like to paraphrase his quote, we like to pair our entries with a clear understanding of the move that is about to unfold. On the other hand, if central bank action changes market trends and the euro starts moving higher, aligning itself with the seasonal tendency, then we will look for the opposite to happen and for the swing high at 1.07935 to be taken out. In this case, price action would show the reverse of the prior bearish scenario we painted, and we would look for a setup to form after the break of the prior swing high at 1.07935. That will be for our longer term trades. Now, we would have no problems trading against a higher time frame trend when we do it intraday or when we scalp, but for a longer term trade, we will look for indications that the trend has indeed been broken. This is all for this video. Stay tuned for more educational material that we can put to use in current markets. Take care.